This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Good evening, everyone, and welcome to a special edition of Nightly Business Report. Well, believe it or not, the first quarter of the year is just about in the books, and this time around, the first quarter was unlike any one we've really ever seen.
Absolutely. Investors were whipsawed and had their nerves frayed by big plunges and sharp snapbacks. So tonight, with one quarter just about in the rearview mirror, we're going to look ahead to what we might expect as the second quarter rolls in and how your money might be impacted.
And we will begin tonight with stocks. 2016 started in the worst way possible, with the market plunging, sparking fears of a recession and dredging up feelings eerily similar to those of the financial crisis less than a decade ago. But then a funny thing happened on the way down. Stocks reversed and all started to seem right with the world again. So what's next? Dom Chu takes a quick look.
So, after what started off as one of the worst starts to a year for the stock market in history, we're right back to around flat for 2016, give or take a few points here and there. Both bulls and bears are feeling pretty good about their respective cases. After dropping 11%, the trend of bounce backs has continued for the large cap S&P 500 index. However, the parts of the market that are leading the way higher leave a lot to be desired. The biggest gains have come from high dividend-paying sectors like telecom stocks and utilities, the sectors that investors flock to when they're worried about the economy. But some are optimistic about the market, assuming some big negative factors change course.
Remember the biggest negative last year? Well, there were two: declining oil and the rise in the dollar. And both of those things, at least for now, have reversed themselves. If we can get some of that, we'll have some modest earnings improvement for the full year. And that is what is necessary for stocks to do okay.
And that's not it. After all, the stock market story is a global one, and the bigger picture or macro concerns will be front and center for the rest of the year as well.
I think there's going to be two big factors that will influence the rest of this year's trade. One is the health of the global economy. In particular, is China able to soft land, and is Europe able to continue to grow at 1 to 1.5%? The second element has to do with central banks, particularly central banks in Europe, in Japan, in China, still able and willing to repress financial volatility, not because they love markets, but because that's the only way they can promote economic growth.
The market has given investors a chance to reevaluate things. 2016 losses are now gone, at least when it comes to some of the major indices. Now, the question is, what will they do after hitting that reset button? For Nightly Business Report, I'm Dominic Chu.
Doug Gordon joins us now to tell us what he's expecting from the financial markets next quarter and what it might mean for your money. He is Senior Portfolio Manager at Russell Investments. Nice to have you here, Doug. Welcome. Are you
Great to join you, Sue. Thank you.
Are you still looking overall for 2016s for kind of low single digits returns globally?
No, that's right. I think that we're looking forward, after the volatile start to the year, that we'll still see something in that low to mid-single digits returns from the equity part of the portfolio going forward. There's still a lot of really open questions, both tied to divergent monetary policy, as we see not only what happens, but then how effective those monetary policy responses prove to be. Also, we still have to kind of get out of the woods a little bit, I think, with respect to the impact of that slower, bumpy start in earnings as well.
Let's look at two issues that certainly are going to be in the news for the rest of this year. One is the threat of terror, particularly how it might affect the European economies, and the other is the U.S. presidential race. How do you see those two things affecting share prices?
Yeah, Tyler, it's an interesting question, one that we normally don't have to think about, kind of these outside factors that influence markets very materially, potentially. Obviously, the threat with respect to what we've seen thus far in Europe as well as around the world, it's a concern that's going to go forward. There certainly will be elevated responses, but again, we have to see how effective those are. It's one of those prove the negative. You know, when we don't know what the terror event could have been and it was thwarted, well, we don't see the impact, so we can't measure it. But when bad things happen, certainly like we unfortunately tragically saw in Brussels this week, that obviously brings to light what the potential impact can be. Domestically here in the United States, the presidential election puts another wrinkle into capital markets and markets going forward in 2016. I think one thing we do know amid a lot that we don't on that election is if we do assume the two potential candidates and a potential Trump v. Clinton election, is that both of them will probably have a bit of trouble getting policy through a Congress that will likely, at least on the House side, stay aligned with the Republicans. And that might give a little bit more runway in terms of time for response to any regulatory or policy changes.
The other thing that your team is watching is Fed tightening. And now the overarching theme on the street is that they will not raise rates as often as originally said they would. But they're still, even if they do raise rates once or maybe twice through the rest of the year, they're still going counter to their central bank counterparts around the globe.
Yeah, that's exactly right, Sue. That divergent monetary policy is going to be a really interesting path forward, both with respect to what the dollar does relative to other developed market currencies, and then as well as with respect to how the market responds to that. I think what we need to watch domestically certainly will be that bright spot that we've had in the U.S. economy thus far, which has been the labor market. We still see relatively robust payroll gains somewhere in the range of averaging 160,000 for the rest, or for a forward 12-month perspective. I think earnings, again, as I mentioned before, where we're going to have to look and see if that stumble in the first part of the year ripples into. We've had good numbers on the EPS side, but expectations have pulled back. It will be that earnings growth number that will concern us. Also, as I mentioned before, it's efficacy of these policies too. We've had the ECB put very accommodative policies forward. We need to see the uptake of the targeted LRTO program and then how that ripples into credit and lending growth in the Eurozone.
Very quick answer here. In the equity markets, do you like America, Europe, Asia, Japan, which? Very quick.
Yeah, outside the U.S., developed markets look a little better to us right now from a fully hedged perspective. And that's in part because we have that uncertainty that Sue mentioned around monetary policy in the United States and that pace.
All right, Doug, thank you so much. Good to see you again. Doug
My
Gordon
pleasure.
with Russell Investments. It was the same issue for oil as for stocks in the first quarter. For the first part, we hovered in the 20s and then things changed. Jackie DeAngelis has more on the reversal in oil.
A bumpy quarter for crude oil prices. We saw crude go down to that $26 level for the second time before it rebounded back to $40. The dip attributable to the global supply glut. The bounce back due to rumors in the market that a production freeze could help stabilize the market and hopes that the summer driving season will start to boost demand. But even if global producers meet in Qatar on April 17th, can a consensus be reached? And would an agreement to freeze production at current levels be enough to support oil prices?
I would think there's a freeze now. That should be enough. Now, granted, that means that the demand must increase here, which is something I am expecting in this driving season that's coming up.
Freeze or no freeze, the fear at the moment is that producers will feel comfortable pumping more in a higher price environment, only to drive the market down again. And if history is an indicator, last year prices fell in June when stockpiles were little diminished. Summer driving demand wasn't enough to balance supply and demand overall. And consumers are feeling the recent spike at the pump. AAA says the national average is hovering back around $2 a gallon, up more than a quarter from a month ago.
I think the gas prices could rise a bit over this driving season, but I don't think it's going to be anything that's going to discourage motorists from using, more gas, let's say driving a little more. This is still a big improvement over the last couple of years as far as their costs. So I would say this is a positive gas season, and there will be extra consumption from previous years.
But investors and analysts, they're remaining cautious. They say the run-up in crude oil prices, more than 20% in the last month alone, leaves little room to run.
And Jackie joins us now to talk a little bit more about what we might expect from here. Jackie, I don't know whether 40 is the new 20 or 20 is the new 60 or black is the new red. I don't know. But I do know that there's a meeting in mid-April, as you mentioned in the piece there. Who's going to be there? What are they aiming to accomplish?
Well, that's an excellent question, Tyler. And this is a producer meeting, not just of OPEC members. It's global producers. Very hard to coordinate an effort for this and actually get a date on the table. But the problem is not everybody is coming to the table. So how do you implement a freeze when all of the parties aren't necessarily coming to discuss? You have certain OPEC members like Libya that aren't coming. And I certainly haven't heard anything about about the U.S. coming to the table to talk about production cuts either. Russia is one of the non-OPEC producers that may be there. Obviously, they're more interested in implementing a freeze at this point. But unless you get all the parties together, and even if you did, consensus is so hard to reach.
Yeah, and then that begs the question, can we see oil back at $50 or $60 a barrel by the end of the year, as some strategists have gone out on a limb and are expecting?
Yeah, some of the investment banks, some of the analysts out there, they are holding firm to those forecasts. They think 50 or 60 is possible. But then I have others on the other side of the table that are saying, no, actually from here, this was a little bit maybe of a head fake run up. We probably are going to go back into the 20s again, and that there's a possibility of that before things get better. So I think you've got to settle in for a bumpy ride this year. And I think 50 to 60, very optimistic.
Gasoline has been going up just a little bit where I buy it in suburban New Jersey. What are we looking for over the next few months and then into the fall?
You know, it's difficult to say with gasoline exactly as well, but I can tell you this. The national average, according to AAA, hovering just around $2 as we're heading into the summer driving season. So you are going to see a little bit of a bump from here as the demand starts to hit the road as we get into the warmer months. But that demand usually peaks in July, just around July 4th. Seasonally, in the bad years, the average around then has been about $3, if not sometimes a little bit over that. I do not think you're going to see that this year. So as Jeff said in the piece, it's definitely going to be a little bit easier on your wallet, but it's not going to be as great as it's been.
All right, Jackie, thanks very much. Jackie DeAngelis reporting. Well, the Federal Reserve did not raise interest rates in its two meetings during the first quarter, but there is belief that it's April or June. Those meetings could be in play. Stephen Friedman is senior investment strategist with BNP Paribas. Stephen, welcome. Good to have you with us. You know, I think a lot of people thought that based on the meetings in March that well, there were probably only going to be two hikes. They're probably going to be June, probably going to be December after the election. But now there is some talk that maybe April is on the table. What do you think?
Well, that's a very good question. There have been a lot of Fed presidents come out in recent days and make the point that April is a live meeting. In theory, I agree, but I think the issue here is that the Fed has signaled that they're very concerned about global risks, and it's hard to imagine in just 6 weeks they'll have that much more confidence in the global outlook that they will proceed with raising rates.
We've seen a terrorism incident recently. Does that play into the Fed being worried about the global situation? Because we have seen economic growth after terrorist incidents decline.
That's a possibility. I think it's just one of the risks that they consider. I think largely, though, what they've been focusing on is just the fact that a lot of the indicators point to a slowing in global growth momentum. We see it in a lot of the surveys of business activity. We see it in the hard data, and they're just concerned that that will eventually have an impact on the U.S. And there is some concern in the U.S. data as well that's pointing to slowing growth ahead.
You know, Stephen, it is relatively rare that you have a divergence of central banks, with many central banks cutting and seemingly ours on the verge of raising interest rates. Is that of concern to you or not?
Well, I think it is a challenge and that they're very aware of it. And I think that's why we're seeing them signal a likely shallower path for interest rates. I think they're quite aware at this point that if they were to forge ahead with a steady diet of rate increases as they had projected in December, that would likely lead to a much stronger dollar, which would only make it more difficult for them to meet their growth and inflation objectives.
Well, speaking of inflation, there's not much inflation out there. I mean, how do they finesse, if you will, the target that they've put out there that they hope to achieve on inflation that we're not even anywhere close to?
Now, I think, again, this points to why they feel that they can go very, very slowly. And we're actually seeing their messaging on inflation change a little bit. What we've seen over the last month or two is greater emphasis in their communications on the fact that they're willing to tolerate inflation above 2%. And I think earlier there was a perception in markets that the 2% objective was actually more of a ceiling. And they're trying to push back on that in an attempt to put some support underneath inflation expectations and raise expectations.
Talk to me for a moment about two things that seem to concern some commentators. One is the size of the balance sheets that both the U.S. and now increasingly the ECB have, and whether that poses a long-term risk of some or any sort to economic growth. And the second one is whether the central banks are running out of tools to influence economies.
Two very good questions, and I think they both feed into this narrative that central banks are essentially out of bullets. On the balance sheet side, it's not something that I'm particularly concerned about. One could argue that eventually the size of the balance sheet could lead to losses for central banks. That is more of a political issue. Central banks can operate with negative capital. They have in the past. But it can be an issue if it becomes an issue for politicians and can impede central bank independence. So in that sense, there might be some limit to quantitative easing. That's the main concern I would have about balance sheet growth. Now, on this issue of our central banks running short on tools, this has been a very strong narrative in markets over the last month or two, and I think it's been one of the reasons why we saw that deterioration in risk sentiment in January and February. It's not a narrative that I put a lot of faith in. I think for central banks, they might appreciate that their tools may have some declining benefits, but if those are the tools they have, I would expect them to respond to that with even more forceful policy.
Right. Stephen, thank you very much. Stephen Friedman with BNP Paribas.
And as we draw closer to this summer's political conventions, the race for the White House is intensifying, and the primaries that take place in the second quarter will go a long way in determining the candidates for both parties. John Harwood joins us from Washington tonight. John, welcome. As always, are both nomination races basically over, or are they still in play?
Not quite. The Democratic race is more over than the Republican race. Hillary Clinton's got a substantial lead over Bernie Sanders. Very difficult under Democratic rules for Sanders to catch up. He's got to start winning not only big states, but he's got to win them by big margins. That's very difficult to do. No sign that he's going to be able to do that. On the Republican side, Donald Trump has got a lead, but it's still unclear how certain it is that he can get the 1,237 delegates he needs to be nominated on the first ballot. Stop Trump forces are rallying around Ted Cruz. John Kasich's been fading a bit, although he hopes when the race moves back east to have some prospect to pick up some victories. Ted Cruz is looking to Wisconsin as a place to slow down Donald Trump. But Donald Trump remains in the driver's seat. Somebody's got to knock him off. It hasn't happened in the recent contests.
You know, if both parties are becoming used to the idea of a Donald Trump candidacy in the general election, how do they assess his prospects to win, especially against Hillary Clinton?
Well, a couple things about that. First of all, most of the polling now suggests that Hillary Clinton has an advantage over Trump in the general election. He's been a very divisive candidate. He has repelled non-white voters, and that's an important part of the Democratic coalition. So if you had to make a judgment right now, you'd say Hillary Clinton's a strong favorite. But there is, even within the Clinton campaign, a bit of wariness about Trump, a feeling that he's more of a wild card than they've expected. He's broken all the rules so far. If he can increase the Republican share of the white vote by a small but significant margin without having any other effects in other parts of the electorate, he could win the race by flipping some states that President Obama won in 2012. It's an uphill fight for him, but not impossible.
Fascinating stuff. John, thank you so much. John Harwood in Washington.
Up next, what's in store for the upcoming spring travel season and a check on how the spring selling season is unfolding for houses.
Spring officially arrived less than a week ago, but the spring selling season for housing has been underway for a while now. Diana Olick joins us now with a look at how things have been shaping up. So Diana, always good to see you. We got some mixed signals from housing recently. Existing home sales fell sharply, but newly built home sales are rising. So what's going on here?
Well, Sue, it really has to do with supply. There is a very tight supply of existing homes for sale, which is pushing prices higher and actually slowing down the sales because there just aren't that many homes for sale. New homes, there's a lot more supply, but again, you're paying a price premium for new home sales. And new home sales are still running below historical averages. They're just doing a little bit better. The question going forward is, will the big builders benefit over the fact that there are so few existing homes for sale?
Let's talk about the price rise that you just mentioned. They are rising, but is that straining affordability both for first-time buyers and for people who would like to trade up?
Absolutely on both counts. It's straining affordability for the first-time buyer who is still being sidelined. Just 30% of buyers in February were first-timers. That number should be around, the share should be around 40%. We're also seeing people afraid to move up, afraid they're not going to be able to afford that move-up home, so they're not listing their home. And remember, for sellers, it's not a limit. It's not that the sky is the limit. They're going to have to look at what the comps are and be smart about how they're selling.
Okay, so that's one tip if I'm going to sell my house and list it this month. What are some other things that the seller should consider?
Well, one thing, list your house on Thursday. I'm not kidding.
Really?
People say that on Thursday, you're going to see most of the potential buyers trolling the internet, looking for homes that just came on, and they're going to be mapping out their open house touring for the weekend. So Thursday is the perfect day to list your home. Don't list over the weekend because people won't see it.
Fascinating. Staging is a big thing now.
Yes. Staging is a big thing right now. You absolutely want to stage your home, and more professionals are doing it. And interestingly, a lot of real estate agents are starting to pay for the staging themselves, saying that it is worth it in the price that they're going to get for that home. So even if you think your house is absolutely gorgeous and perfect, you do want to stage it. Don't just clean it up. Make sure the rooms look clean, fresh, and impersonal. Someone lives there, but not necessarily you live there, because the buyer wants to be able to picture themselves there. And again, that last one is the sky is not the limit. Buyers are not stupid. They know what the homes are worth.
That's right. I wish somebody would come stage my house.
And buyers ultimately set the price, not the sellers.
That's exactly right. Thanks, Diana. As always, Diana Olick.
Well, this Easter weekend marks the unofficial start of the spring travel season, and while security will be top of mind following this week's attacks in Belgium, people are still making plans for getaways. The traditional destinations will get the usual throngs of visitors, but this year, some places off the beaten path are getting attention. Phil LeBeau has a look.
As winter winds down, spring break is heating up, especially in the Caribbean, where those looking to get away are finding their way to less popular spots.
A lot of people now are looking for alternatives that may be a little more laid back, a little more relaxing. Places like Playa del Carmen, Riviera Maya, where they may not be paying as much, and they're also going to have a little bit of a different feel.
Overall, Orbit says airfares this spring are down roughly 15% compared to a year ago, partially because of the drop in fuel costs and because more airlines are adding routes to the Caribbean, and that's pushing fares lower. That's the good news. The bad news? Hotel rates are edging higher, largely because of greater demand.
They'll see a slight increase overall of about 4% in accommodation prices, but there are markets where there's actually substantial savings.
Europe remains a popular trip for a couple of reasons. First, airfares have been falling. Second, the euro remains weak, which means Americans are getting more bang for their buck at hotels, restaurants, and shops.
We're seeing that the strength of the dollar abroad is really attracting people to upgrade their spring break destinations to go places that are further away and that have typically been more expensive, places like Paris, Dublin, even Panama City, Panama, where we've seen an increase over the last 5 years of 476% in hotel bookings.
As for those who are driving somewhere for a long weekend or spring break, there's good news as well. While gas prices have moved higher in the last month, they're still lower than where they were a year ago. And most experts believe gas prices will stay at around $2 a gallon as we head into the summer. Phil LeBeau, Nightly Business Report, Chicago.
Coming up, what to do to protect your hard-earned money in the years leading up to your retirement. Market volatility, I tried to say, like what we've seen this quarter, can wear on the nerves of the most seasoned investors. But what about those closing in on the end of their working careers, the decade or so before calling it quits? Sharon Epperson has some tips for those heading into that retirement danger zone.
63-year-old Michelle Jeggi has been planning for retirement, putting her money into stocks for decades.
I've been a big investor. That's the way to grow. It's a rocky road, but that's the way to grow.
Now Jeggy, who runs her own insurance business in suburban New Jersey, is in the danger zone. Those last 5 to 10 years before retirement can make or break your financial future, especially if you leave your hard-earned money exposed to too much risk.
I've always invested at least 30% of my money, if not more.
But an unexpected financial crisis can wreak havoc on investments. Think about 2008, when the average U.S. worker lost about 24% of the balance in their 401k account. Even in better times, market volatility, always unpredictable, could seriously damage your nest egg. Jeggy is working closely with financial advisor Jeff Boyer to make changes that will keep her money safe.
Putting a retirement plan in place means making sure that clients are going to have a successful financial plan in good, average, and in poor markets. So essentially, if we've got a financial plan that's going to work in all of those environments, we've sort of taken the market out of the equation.
Ramping up to retirement, Boyer and other financial advisors agree it is important for investors to diversify assets, minimize the tax impact, and maximize Social Security benefits.
The dollars at stake between delaying Social Security to age 70 and accepting it early at age 62 can add up to hundreds of thousands of dollars in additional benefits.
Working longer may also help Jeggy avoid getting trapped by the danger zone.
If I still love what I'm doing and I'm able to do it, I can see myself working to 70.
Jeggy plans to continue working, saving, and investing to secure her financial future. For Nightly Business Report, I'm Sharon Epperson.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching.
And I'm Tyler Matheson. Happy Easter, everybody. Have a great weekend. We'll see you Monday.